Good afternoon, everyone. Thank you so much for coming again. This is the final session. Thank you, Katishia, for this very informative webinars, understanding your business numbers. So today we will cover the cash flow statement.
Yes, and thank you, Emil. Can you see the screen okay?
Yes,
Okay, great. Thank you, Emil, for having me in Common Capital. Again, I can't sing your praises enough. You all have been just a great service to the community. And you, in particular, are a great advocate for business owners and definitely fight for the business owners all the way. So thank you for the work and the service that you all do. And thank you for all you, those have joined, whether this is your first or your third. Or second, anything in between. Thank you for coming. Thank you for the work that you do. What I love probably the most about my opportunity to serve is the clients and just seeing the amazing work that they do and their passion with which they do it and their skill and expertise and all the great things that you do. Like small businesses are the backbone of the economy. All the big guys may get all of the fanfare, but it's the small business. Look up the statistics. It's the small business that employ the most people and add the most as far as contribution to the well-being of this country in particular. So thank you all for what you're doing, either profit or nonprofit, big, small, anything in between. You all are making an impact, and that's what's most important. And what I've found with those that are oftentimes very great at what they do, sometimes is that back office piece that can be a bit of a struggle, and particularly the financial pieces. That's my area of expertise. The financial piece can be a place where it can cause a bit of angst. So I'll begin today how I ended last session and just check in. How are you doing? How do you feel about the financial aspect of your organization? Do you feel fairly confident, or is there something that you want to know more about, or is there something even today that you would like for us to make sure that we touch on, in particular with the statement of cash flow or the cash flow statement? How are you all doing? Are you doing okay? I love
Good.
finance. I talk about them all the time, but how you? Somebody said good.
Mark said good.
All right, great,
Yeah.
Mark. All right, I love.
I just wanted to say to you that uh, the I love the information that you've provided. It's been really on the money for me. Really, really useful. It's not something that I'm able to apply immediately, but I know that I'm going to go back to these seminars and look at them when I'm a little bit further down the road on some of the stuff, and I'm going to use some of the tools that you've given us and try and apply them and see whether a light goes on for me when I'm comparing what you've told us with what I'm seeing in front of me. So it's really great stuff. I appreciate it.
Oh, awesome. My pleasure. And that's my hope too. You're gaining awareness here, and then as you really need it, hopefully you'll have now some reference materials, the recording that Emil have been sending out, as well as the slides and the handouts. The handouts have a bit more of an overview as well as some definition of some key terms. So you'll have some resources to go back and you'll have it in your toolbox when you need it, right? So that's the
Yeah.
key. Hopefully you all will take away something away that's helpful. Today, this is the part three of a three-part series. We've been looking at the three main financial statements. Today, we're looking at the statement of cash flow or the cash flow statement, answering the question, are we sustainable? Three sessions asked and answered three questions. The first session, we looked at the profit and loss statement or P&L or income statement, and we asked the question, are we profitable? The P&L statement measures revenue. That's money that's coming in from sales, right? Or donations or whatever way that money comes in after you offer your service or make your product available to the public. It subtracts out the costs that are incurred, and that bottom line, it shows the profit or loss. If you have a profit, then that's what you pay tax on. So profit is a tax construct. last week we talked about the balance sheet. We talked about, are we healthy? So we're looking at this example of this business and this organization. So she was profitable. We'll see, and I'll review it a little bit more. But then when we looked at the balance sheet, that was the metric that was able to show some things that show some stress signals. And the balance sheet shows what the business owns or the organization owns, as well as what it owes in terms of liability and the difference between those in terms of equity, right? And then today we're going to talk about the cash flow statement. Are we sustainable? And cash flow statement is just simply money in, money out, right? This is our sample company, but I invite you again to look at what you've learned today or pick up within these sessions and apply it, if you may, to your own business. But this is our sample company, Bright Path. The owner is Maya Chen. It's an HR firm, 8 staff members, 5 consultants, 2 project coordinators, as well as 1 part-time bookkeeper. Her revenue model is such that 60% is that month-to-month steady retainer clients, and 40% of her revenue comes in from one-off clients. This is her 4th year of operation. We'll see she makes over 1 million in revenue, but she came to us feeling tight. She wants to know where that money goes. Can you imagine that? Even making millions of dollars or being in over $1 million, but still be up at night because you can't make payroll or you can't afford that next purchase, that big purchase that you have to make, or you can't afford that travel costs right now are going through the roof. It makes you want to, drive or walk or do something because travel costs are really a big line item right now. But so it doesn't matter so much the revenue, it matters those costs and profit and then cash. I'll show you the difference between the 3. By way of review, this is the income statement. We're looking at year 4. Again, 1.2 million in revenue. Her cost of sales was 506, giving a gross profit of $735,000, which is a 60% gross margin percentage. In other words, for every $1 of revenue that's brought in, 40 cents went to pay the direct consultants that actually do the hands-on work in her business. If you sold a product, it would be those specific materials and shipping costs and all those things, that packaging and things like that, all the ingredients for a pierogi person, everything that goes in making that good for sale or offering that service to the public, that's the cost of sales or cost of services. So 40 cents in this instance, or 40%, would go towards those direct costs. And then the gross profit, she would have 60 cents left to pay those operating expenses. And so these are the operating expenses: salaries, rent, utilities, software, technology, marketing, such and the like, until you get all the way down to net income was 87,400. So revenue came in. So like if she's online and one of those people's like, oh, I have $1 million company. All right. But then when you start look at the cost that, that it takes to run $1 million company in this particular instance, at the end of the day, she is profitable, which is a kudos. I've seen many $1 million companies that are losing money, right? She has net income, but her gross margin is 7%. So this net income divided by the revenue is that gross margin. So that's how you would determine those metrics. And these are the numbers for this particular business. Revenue steady grew, margins are steady, but she still feels cash strapped. When we talked last week about the balance sheet, we saw a bit of what's going on. We saw cash dip all the way down, right? Her end of year cash is 34,000. Then we saw this huge accounts receivable. And it actually increased from year to year. So accounts receivable, when we looked at the profit and loss, the revenue is booked when she earned it and when she invoiced it. And one of the given facts is that her terms is that when she invoices, she has a net 60 payment terms, right? So she invoices them, does the work, and they have 60 days to pay her. Now you may think that's crazy, but if you work in certain industries, that could be the norm, especially if you're dealing with insurance companies, maybe if you're getting revenue and money coming in from corporate funding or government funding. it may take you 60 days to get paid, right? So such is the instance here. Her receivable balance is increases and is trending up. So this is, she earned $118,200 that she hasn't collected by the end of the year. And that increased at about $40,000 throughout the year. So that's where we begin to see a little bit of what's going on here. We also saw an investment in equipment or the asset, right? She bought some type of equipment during the year. We also saw that she began for the first time to draw down her credit line. So she began to subsidize cash flow issues by getting a line of credit. And so that's the nature of the liability that was on the books, as well as with the equipment, she purchased it using a loan. So then we start to get a little bit clearer picture of why she's starting to feel tight. We got these huge accounts receivable that she hasn't collected on, and then she's starting to draw on loans for the first time to fund her operations. And so here, like I'll preach this gospel to forever. Revenue does not equal profit, does not equals cash. They are three distinct things. So screenshot this, save it till you memorize it and know it. So when people, oftentimes they like to flash that revenue as vanity, but then revenue is what you make in from sales, right? It answers the question, how much did you earn? Profit is what did you make after paying those expenses? Right? But cash is actually in the bank. When you need to run payroll, when you need to make a purchase, when you need to pay down your bills, right? Or your loan payment, cash is what's in the bank. Those are three different fundamental concepts when it comes to um, um, for money coming into your business, and that's what's left over in your business. Very, very important to know the difference between those. And so in this particular instance, her revenue was 1.2 million, net income was 87.4, and cash so it's kind of like you see the money's kind of just dwindling down. So right. So things revenue is a great metric, and as you scale and grow, oftentimes it takes money to grow, right? And so that may affect and impact your profitability, and especially with the way that her revenue model is, it's affecting her cash in the bank. Questions or comments as we go on are welcomed. You can drop it in the chat or just chime in.
This is interesting to me. This is Earl, because you have a situation where revenues grew, right? Cash actually went down, and yet they actually increased their leverage. So they actually saved cash there. You have a increase in receivables, which ultimately impacts your cash flow in a negative way, actually. So this is interesting in that this clearly is a cash flow issue, and it does show what you emphasize, which is, cash is king.
Yeah, I
Operational,
remember that. Yeah.
cash from operations. It would be interesting to see that, whether or not it was negative or positive is probably, break even or maybe slightly negative. But yeah, that's my comment. It's sort of interesting because I see a lot of, circumstances like this, actually.
For sure. Yeah, and I do too. And that's the reason why we wanted to highlight that today. And we'll get more into the cash flow statement today. But just by way of reminder, this is some metrics that we have looked at over sessions 1 and 2, and those replays are available and the notes are available. So I'll be going to the doctor for a regular checkup next week. He's going to take a few metrics. He's going to take my blood pressure. He's going to take my pulse, going to take my weight, certain things. These are vital statistics. They know a baseline. And when things deviate from that baseline, then you start to ask the question, why? What is going on? We know where the healthy range is. Why is your metric out of range? So I already know during tax time, my blood pressure is going to be through the roof. My pulse rate is going to be through the roof. So I know that's an unusual. I can answer that question. Why? But for what us in businesses, we can start to develop our own key performance indicators or metrics that we can use. If you don't take anything else away from me, if you would just start to pick maybe one or two of these and begin to get a baseline measurement of what it is now, and then begin to remeasure it within another month, the next from quarter to quarter and year to year, and see how it changed, and then see and ask your question and ask yourself, the business, why did that metric change? And then that's when you can dive deeper in and see, what are the levers that affects that growth or contraction. And we've talked about 5 of them in the past. We talked about gross profit margin, which is the revenue minus cost of goods sold is your gross profit. You take that as a percentage of revenue, you get your gross profit margin. You go all the way down to the net profit, which is your bottom line. You take that number, dollar number, as a percentage of revenue, that's your net profit margin. We also talked about break-even points, which you fix costs, and then you divide it by this first number here, and that's the minimum amount of revenue that you need to break even, 0. You're not making money, but you're not losing money, you're breaking even, right? So you have the formulas to compute these numbers. Maybe compute them on your own from your own business, and then see how they change from time to time. Last week, we talked about on the balance sheet, the current ratio, which looks at your current assets, which are those assets that can be liquidated into cash within a year, right? Divided by your current liabilities, which are those liabilities, those debts that you owe within the next year. And you divide that and you get a ratio. And you want it to ideally be above 1.0. We saw last week that although Maya's current ratio was 2.5 or more, when we looked at the cash ratio and looked at cash over current liabilities, we saw that she didn't have enough cash to cover those liabilities that were due within the year. So most of her current assets that she had that were liquid were in her receivables, right? And when you look at cash, if those liabilities become due upon demand, and she needed to pay everything, all her current liabilities at one time, she didn't have enough cash to do that. And so these are some of the metrics that you can run within your own business. Even those in the financial world will look at these. These are kind of called liquidity ratios, and these are kind of profit ratios. You can kind of develop your own dashboard of metrics that you would measure from time to time to see how things change. And then that's when you can begin to interrogate it and dive a little bit deeper to see how you can change that or improve that, or know what factors may be changing that. If you're in an industry that has been affected by inflation or tariffs, you may find that it costs more to get your materials this year than it cost you last year or the year before. These all affects those metrics, right? So these are kind of the ways that you can kind of get maybe back the envelope type of numbers that you can run and be able to have your own health vitals, right, for your business to see how things are going. So far, we talked about, are we profitable and are we healthy? We saw she was profitable, but then we saw some stress signals. We saw cash fell. We saw receivables surge. In other words, she had some money that hasn't been collected, even though she performed the services. And we saw that she started to draw on credit or debt, right? And we saw that equity began to decline. She took out a large owner's draw that affected her balance sheet. These are all by way of review on the past sessions. So then we talk about today, profit 87.4. We saw cash go down by 14,000. I'd like to know if you drop in the chat, why do you think that has happened? Would you think it's option A, the business is losing money somewhere that we can't see? Why is she feeling so tight? You think it's option B, the owner is taking too much out? We found out last week she's taking out 100,000. Or do you think it's an option C, that the timing between earning money and collecting it is creating some type of structural gap? So if you were to guess, or if you were to take your educated guess on what you think the reason why things are feeling so tight? Do you think it's option A, option B, option C, or something else? You can drop it in the chat, or you can talk about it. Could be all. I like that, Josh. I like that, Josh. And then we got a bunch of C's popping in. Okay. All right. Good, good. Anybody willing to, provide a little narrative behind your guest there? Anybody willing to share a little bit on that, or why you think they're so tight, or explain why you chose what you chose? Multiple factors, says Earl. Okay. All right, cool. All right, well, let's dig in a little bit deeper and find out a little bit more. Cash flow statement, what it shows actual is straight money in, money out. It doesn't care whether the money is from revenue. It doesn't care whether the money's from loans. It doesn't care whether it's owner's investment. It's just showing straight money in, money out, right? What it answers the question, did this business generate enough cash to sustain itself? Right? And what it does not show, it's not going to show you, it's not going to have a revenue number, profit. It doesn't show, what's on the balance, what it doesn't show what the business owns versus what it owes. It's just straight money in, money out, right? See if I can move a little quicker. Here's a stark reality of cash flow. 82% of businesses fail due to cash flow problems. Here is a live link that you can go right to SCORE and get the write-up on that. That's a statistic. It's been around and it's true. And it's not just, there's even anecdotal evidence with it. I've seen business owners that come to me that are on the verge of collapsing because, revenue's coming in, but that cash flow, they don't have enough to sustain themselves. Cash flow statement has 3 categories of cash movement. So this is high level. You're going to have your handout. There's 3 categories of movement, and there's also 2 methods of preparing the cash flow statement. So the 3 categories of movement is operating activities. So that's cash from your day-to-day operations. That's your rent, that's your money, that's your sales, that's your marketing, that's money going out, in and out from operating the business or organization. The second bucket is investing. This is cash used or generated from the purchase or sale of long-term assets. So who's going to tell me what statement do we go to look to find if there was a purchase or a sale of assets? Where are we going to find that information? Which statement? The P&L, the balance sheet, where are we going to find it from one of those? Balance sheet. You're exactly right. Yep, that's what we're going to find. So we see the cash flow statement is kind of a blend. It's going to take some things from the P&L, but it's also going to take some things from the balance sheet. That's investing activities. Then the last category is financing. That's cash that flows between its owners and its creditors. So that's if me as the owner gives invest money in the business, or if I take money out as an owner's draw, that's going to show under the financing bucket. If I get a loan, that's going to show an increase in cash flow. If I pay down debt, that's going to show an outflow on the financing portion of the balance sheet. All right, let's see if I have a picture of what this looks like. Oh, this is the 2 different methods. So there's the direct method and the indirect method. If you got QuickBooks, if you got Wave, let me put a 1 in the chat if you're using QuickBooks, put a 2 in the chat if you're using some other software, and put a 3 in the chat if you're using spreadsheet. You're not using any of them right now, right? All right, so we got 2. Somebody's using 2. We got another 2 showing up. All right, so QuickBooks, we got 1 person using QuickBooks. I got something. Whoo, I got a bone to pick with them sometime on QuickBooks. We got another QuickBooks unit. Okay, all right. So it's about half and half between QuickBooks and another software. If you run a cash flow statement through QuickBooks Wave Zero, they're gonna use the indirect method. It's more confusing, but that's what they're gonna use. The direct method is more straightforward, and I'm going to show you a link to where you can download a spreadsheet to use it. But the direct method shows, you're going to see it's just going to show money in, money out. Indirect method is going to start with the P&L, profit and loss, and then it's going to make adjustments for what happened on the balance sheet from operations, from investing, and from finance. All right, I'm going to start by explaining the direct method. You'll have the handout for the indirect method, and we'll try to reconcile it and see. I don't want to dig too deep in the weeds, but I do want you to be informed, especially if you're using a software that is going to automatically give you the indirect method. So this cash flow statement from SCORE, this website, is going to give you, let me see if I have it pulled up. If you go to that website, it's going to, and it's going to be in the slides, it's going to provide, you can download for free this spreadsheet. Let's see. All right. So this is the spreadsheet that when you go to SCORE, this is what you see. And it's going to be straight money coming in, month. You can either do, sometimes this right now, the columns are by month, but for some of my clients, I have each of these columns by week. Things are so tight, we have to triage cash flow. So we're doing week by week. We're showing what money is expected to come in minus what money is expected to go out. And then it gives you the net cash position at the end. Straight money in, this is the direct money method. Cash sales, collections from credit accounts, from your receivables, loans coming in, right? That's money into as an injection. And then it looks at what you pay out from purchases, payroll, all rent, telephone. You can go to the website on SCORE and download this for free. This is the direct method, cash flow. It shows it's the easiest way, right, to do this cash flow statement. If I'm using now BrightPath's number, her inflow is 1.1 million. Now her revenue was 1.2, but you remember she's got some money hanging out in accounts receivable, right? So that's why she collected less than she earned in terms of revenue. And that's the tricky thing, because if you're on the accrual method of accounting, that means you report revenue and you may not receive it until next year sometime. Not only do you report that revenue in this year, but you also pay tax on that revenue, right? If you're on the accrual method of accounting. But when you look at from a cash perspective, she collected less than she earned. So she earned for inflows almost 1.2 million, right? And then when we go still on the direct method, we're looking money out, going out, money's paid to consultants, employees, rent, operating expenses, prepaid expenses, interest, that's money outflow, right? And so the net cash from operation is 54.2. We're looking then at invest. We talked about the cash flow statement. Remember, it has three categories. It has operating activities, it has investing activities, and financing activities. We looked at operating activities, which is your day-to-day operation. Now, investing activities, remember she purchased that piece of equipment. That was a cash outflow of almost $14,000. That's going to decrease, cash on the cash flow statement. Investing and outflows are usually healthy. That means that you're reinvesting in capacity. You're building you're purchasing a piece of equipment that's going to make you more efficient. You're doing something that's going to make you more profitable, right? Hopefully, or more, allow you to scale more, right? But then you also have to look at how are you making that investment? Are you paying it through cash or are you financing it? So this is investing activities on the cash flow statement. Hopefully I haven't lost anybody. If I have, stop me, please. And I'll repeat it and try to say it a little bit better. Operating activities, investing activities, now financing activities is what owners put in minus what they took out. She took out $100,000 in owner's draw. She also got some money from a line of credit, $22,000. Also took out another loan. So loans increased, liability, her balance sheet increased by 45 in terms of liabilities. And then she took out owner's draw of 100,000. So the net cash from financing activities actually decreased her cash position by 54,800. Make sense? So we looked at operating activities, which she had a net positive cash flow from operating activities, a net negative cash flow from investing, money went out to purchase equipment, and then also a net negative outflow of cash from financing, mostly from her owner's draw.
So, I have a question. So the owner's draw, um, are we assuming that the owner does not take any salary through the traditional way, and that the only way that the only way that she takes money is through the owner's draw, which, would be consistent. Some cases you do see owners that receive money primarily as a result of tax implications through the normal payroll structure. Hence, they can reduce the owner's draw. Just curious.
Yeah, and so the only way that you can be an employee and receive a wage from your business and have it be on your P&L rather than your balance sheet is if you're an S corporation owner and you're a W-2 wage. If you are LLC owner, you're a sole proprietor, you are going to take your owner's draw is going to come from the balance sheet. You can't take a wage as in the legal sense of a wage. You have to pay yourself via owner's draw. Yeah. So the only way that you're going to get a W-2 from your business is if you are an S corporation and you employ yourself as part of that S corporation. Good question, though. The benefit of being accrual, sometimes there's a statutory requirement of being accrual. The IRS requires some businesses, if you make over a certain millions and millions of dollars, you actually are required to be on the accrual method of accounting. Some construction companies are required to be on the accrual method of accounting. But most of us are usually would start on the cash basis of accounting. So the benefit from an accounting perspective, the benefit of an accrual method is that it matches revenue with expenses. It matches what you earned, even though you haven't collected it, it matches you what you earned and what you actually incurred as far as expenses. That's the accounting benefit of it. But from a cash flow perspective, which is our thrust today, revenue is, we're going to look at revenue as it actually hit the bank from a cash perspective. But thank you for asking the question. And I hope I addressed your question too, Earl. Same business, same year, two ways. The direct method, again, straight money in, money out. Cash collected from clients minus what she paid and those expenses, and show the net cash operation. Your handout is going to show you that indirect method, the one that QuickBooks and Wave and the other softwares provide you. They're going to start with the profit and loss, and then they're going to add certain non-cash items like depreciation that is added back. And then it's going to look at the change on the balance sheet from year to year. And if it increased or decreased, it's going to make adjustments accordingly. But it should get you to the same number. It's just a more complicated way of doing it. But what I want you to walk away with is that she collected 1.1 million. She spent a little under that, 1.144 million, and that the indirect method tells you why the 33,000 of profit did not come in cash. So these adjustments here shows so she earned more in accounts receivable, but she didn't really collect it. Right. And so that's going to try to explain the difference between the cash that she received versus the profit that she has reported on the books. open to questions again, and I'll drop that handout in the chat as well for those that came after we provided it the first time. So the direct versus indirect method, if you're using account software, it's going to give you the indirect method. But I've also provided you a link, and you'll be able to download a spreadsheet that will allow you to use the direct method of accounting to just show, in a much cleaner, easier way to compute with the direct method. And I also put the link in the chat for that score template that shows the straight direct method of the statement of cash flows. Use direct method when you want to understand cash inflow and outflow. Like I said, when I'm in a triage mode with a client and we're trying to figure out week to week when I can, if I'm going to make payroll, when I can pay this bill, I'm using direct method. I'm breaking out a spreadsheet. I'm seeing like week to week, where are we, in our cash position. The indirect method is going to show you a profit to cash kind of gap more explicitly if you look at that statement. In practice, like I said, the accounting software is going to spit it out with an indirect method, but the direct method is more kind of straightforward in terms of money in, money out. Either way is going to show us that this important thing, $43,000 was our increase in accounts receivable, and that's money that she earned that did not make it to the bank in terms of cash. This is in your handout, the indirect method for the business. I just want to, and this slide explains kind of, if you're trying to figure out, if you got your QuickBooks open, you're trying to figure out why a certain number increase minus decrease your cash position. This is kind of going to show you a little bit using this example why those numbers impacted cash the way they did. But here's why this is going to answer her question. Like, I'm making $1 million in revenue. I'm profitable, but why am I tight? Your accounts receivable. It's creating this tension where you've earned this money and then you're paying your consultants to do the work, but you haven't received the money yet, right? And so I'd be open to open it to those. We have had some consultants in the room, and we've had those business owners that have some experience. Here's the question: what should or could Maya do to close this gap with this accounts receivable that's hanging out on her balance sheet as money that's earned but not collected? Does anybody have anything that they would suggest or practices that they have employed in real life that would show how to close this gap with this accounts receivable hanging out there?
Yeah, you would look at the first and foremost, you would look at the terms associated with the accounts receivable account. So I think you said they might be very, very generous. It might be,
Net
60
60.
days. Yeah. So, you may need to cut that back to net 30 or, net 15
Like it.
because, an increase in cash accounts receivable has to be funded some way. It's a
Right.
use of cash, actually.
Use of cash. Is that
So,
correct?
that would be my comment. Sorry.
Excellent. Thank you for sharing. Anybody else have any, examples or suggestions on how to address this accounts receivable that is affecting her cash position and making things tight?
This is Lily. One of the things that my clients find is helpful, especially in the medical field, is to have a decent line of credit available to them, especially when, like a few years back, there was a huge problem with the billing,
Yes.
the problems with the insurance companies because their whole system went down. And so we had a lot of clients who just could not pay their bills because they had hundreds of thousands of dollars. And the best thing they could do in the moment was get a line of credit. And some of them had already prepared for a rainy day in that way. It's the same thing with retailers when they buy a whole bunch of inventory and haven't sold it yet. So, line of credit doesn't cost you anything if you don't use it. So if you can get it, it's great.
Absolutely. Thank you for adding that point. Yeah, and that line of credit, you only pay interest on what you have drawn on. So you don't, you can make the principal payments as you deem appropriate, but you're only paying interest of what you've drawn, and that could be a way for you to kind of fund that gap there. So thank you for bringing that. And I remember that I have some clients that work in the healthcare industry, and I remember when that system went down and they were not getting paid. It was like a couple months that they did not get paid.
Horrible.
Yeah.
It was horrible.
Yeah, that's just not how it should be. Yes. So, all right. So I like that line of credit, drawing a line of credit. We saw Maya did do that for 22,000. We can make adjustment to the payment terms. So these are great, great suggestions. Anybody else as we brainstorm ways to close this gap on this accounts receivable that is affecting her cash position? Those are great suggestions. Anybody else have any thoughts on that? Great. I'm going to probably just repeat some of what you said, and we have some slides here that you can kind of look when we send these out. But we saw that this tightness is a working capital problem. We saw that the cause is that her retainer clients are net 60. So those month-to-month clients, which was 60% of her revenue model, she was earning the revenue today, but not getting paid to 60 days later, right? So month one, she earns the revenue. She doesn't get collect until month three. So that's causing a cash payroll still got to get paid every 2 weeks. I got a little, a little colloquial there. Yeah, she still got to run that payroll. She has to run that payroll every 2 weeks, despite, that lag and when she gets paid, right? So she's perpetually floating her clients. The scale, when you have 60% of your revenue and they're only paying, they're paying you 60 days after you already earned the revenue, you're routinely carrying over $100,000 in receivables, right? And she's drawn on that credit, and she's starting to accrue interest. I like Mark's suggestion here. Mark says, you know what? Sometimes you just got to tighten the belt and review the expenditures. You want to chat a little bit more about that, Mark, or it is what it is?
It is what it is. What are you, what are you going to say? You can't, I don't know. I'm kind of like fiscally conservative in that way. If I don't have it, I can't spend it. Right. So, and I appreciate if you're running a business, you've got obligations, you've got responsibilities. But you should always have the possibility of, going to your people and saying, hey, Donut Friday is suspended until further notice. That's not a good example, but you know what I mean.
I hear you.
Yeah.
And that's some of the things you have to begin to become creative. Like with her accounts receivable, they got next 60. She can, on the other end with accounts payable, see if she can lag the payments a little bit. You don't want to be in a place where you're owing people and you're getting in a bad place. But say maybe with credit cards or even with debt, sometimes you can change the due date from the 15th to the 1st when a big flux of money is coming in. You can kind of have to get creative on when you can pay and, at what point. And if you know that you can't have someone that you maybe can negotiate payment terms, start making those calls on the accounts payable side. And then when when things get tight, like you said, sometimes you just got to tighten that belt. One of the things that I walk my clients through, it's under the Profit First methodology, we do expense analysis and we go on the bank statement and we highlight every expense and we highlight it whether it's a necessity. We highlight it and we highlight those that are negotiable. So maybe they're a necessity, but I may be able to switch the terms of payment, or I may be able to switch to annual versus monthly and save a little bit there. And then we also highlight those that we just plain have to cut. And if oftentimes when you look on your bank statement, there's a lot of even at home, how many subscriptions, how many TV streaming subscriptions do you have? And do you need all of them, right? So the same thing with the business. Sometimes we have software subscription. We have Canva and we have Adobe and we have this. We have ChatGPT and we have Claude and we have multiple places. And sometimes we have to make the hard decision to cut one other over the other. So a good hard expense analysis, sometimes I do it once a quarter. If need be, I need to do it sooner. And we go through all the expenses. Is it a necessity? I have to keep it. Payroll oftentimes is that, right? Is it one that I can negotiate and maybe pay annual instead of monthly and maybe adjust the payment terms or find another vendor that may be more cost effective, right? Or number three, can I just cut it, right? Anybody else? I see someone else chiming in.
When does it pay to get a factor, Katisha? And does it make sense to increase the cost of your services to include the fact that you're going to need a factor, or right? Because it costs money for a factor, but then you're paid right away. What's the difference between that and a line of credit?
What do you mean by factor? Can you explain that?
Yeah. So when I was in retail, let's say, people owed you money. What you could do is you could go to these third party, they're called factors, and they would basically buy your invoices and they would do the collection of it and they would charge you. So let's say you were owed $50,000. They may say, okay, we'll take over the collection of that and it will cost you $1,000 in order to do that. So you got the $50,000 up front and then they collected on those invoices. So it was almost like having a collection service. And it was a fee, but the difference is you're not taking a line of credit. It's a business expense, is how we had taken it.
You know what the contemporary example of that is? Is our payment processors like PayPal, Stripe, and the others. They're offering these loans, and basically what they do is take a percentage of your revenue that you get through the payroll processor in order to pay back those loans. And those fees, I've done the math, they can be exorbitant. If you're in a crunch, I understand. But those fees can be exorbitant. So you have to kind of run the numbers and see if it really makes sense to you. So that's kind of like a contemporary example of what I'm seeing frequently, what's happening. You'll get emails from Square every month or PayPal every month or one of the other ones that are out, almost like payday loans, right? And they'll if you got money coming in and so they see you have revenue, they'll loan you a portion of that. You get the money right away, but then your future revenue is cut by their payment, right? They'll take a certain percentage of your disbursement in order to pay back that loan.
And I've also seen situations where, as it was mentioned, you go to a factor. And essentially what you're doing is you're selling your inventory at a discount, basically. So to the extent that you're selling your inventory at a discount, your revenue is being reduced, and the ability to increase prices is really contingent upon the ability of the consumer, your consumer,
Yes.
to absorb that. And quite frankly, for most businesses right now, it's not realistic.
It's tough. It's tough to raise prices. So, I mean, I would start with like what you all said first, kind of negotiate those payment terms, even negotiate with if this business is growing, right? So if her current clients are net 60, with new clients, I want net 15 or net 30, right? So everything that's coming in, at least now that's money will start coming in sooner. With the current clients, see if they're open to renegotiate that next 60, right? And then with the clients in general, you want to be able, also, she has 60% are retainer, then she has 40% of her clients that's one-off. On those one-off, see if you can get 50% up front or even 100% up front. You're doing a project and see if you can collect some up front instead of waiting to get paid after the work is done, right? So these are some things that you can kind of tweak in the business model, right, to begin to accelerate cash inflow. And then make sure you tighten up your collection. Just start sending out reminders. There's if you're using QuickBooks or Wave or any of those accounting software, they have a way to trigger auto reminders. So when it's due, that's one, email, and then maybe 7 days later, you get another. The client gets another reminder. Hey, this is due, and just automatically it begins to trigger in your client's mind to, pay this outstanding invoice and make that make it a little more easier. Even if you accept electronic payment, make it a little bit easier for them to pay with a click of a button, right? So these are some of the things that you can start to tighten up. And then once you begin that start to get some cash flow in, start to set aside, if you can, some money and build a cash reserve. The, old rule of thumb, it was like, 3 to 6 months. Now, I mean, it's probably even more now because this cash crunch is coming in hot and heavy. So as much as you can save through those cost cutting measures, try to start to tuck that away in a cash reserve so that, you won't have to use those, sell your, inventory at a discount or, try to raise your prices, because depending on your market, especially today, your market may not tolerate an increase in prices right now. And if you try to increase, then you may, lose a customer or lose a sale. And depending on where you are, that might not be the best thing. So I would start to go for the low-hanging fruit first. And then if you need those extreme measures, by all means, I'm not going to tell you not to employ them, but just count the cost. And you have your financial statements now, count the cost, know the implication of selling your inventory at a discount or going to one of these, payment processors and getting those loans. Does that all make sense? Any other comments? Questions? Thank you for that. I wasn't familiar with the factoring term. I might have called it something different back in the days, but thank you for that. So our 3 weeks together, we've looked at the income statement, balance sheet, and today the statement of cash flows. From the income statement, profitability looked good. Balance sheet, we started to see some red flags here or some caution metrics. And then the cash flow, it just kind of showed us, hey, she's got to do something to start accelerating when she receives that money, because it's creating this lag in payment, which is creating a tightness or a constriction in her operating cash flow, money in the bank. And so we talked about some ways to mitigate that and begin to turn the ship around before it gets too late. And that's why I said, begin to choose a metric or two and start measuring it, because that way, in your own way, you begin to see where you can predict things that may be coming down the road that you can start to mitigate now. When you need to pull on a line of credit, the hardest time to do it is when you need cash now, right? That process takes some time, right? So start negotiating, start making those connections with your lenders and starting to see who's out there and who's open, and knock on Common Capital's door if you need some help from, services that they offer or funding that they offer. But the sooner that you start making those decisions and start to mitigate things that may be coming down the road, the better. The worst time to try to make a sale is when you need money in the bank, right? You rather start seeding those relationships and start cultivating those leads early on so that you have a pipeline of what's coming in. And so if you don't take much else, begin to run these statements and begin to measure certain aspects of these financial statements, if it's one of those 5 metrics that we talked about earlier, to begin to know your business, know the seasonality, run a cash flow statement for the year and see when cash flow tends to dip or when it begins to jump, and what you should do in those lean times, and what you should do in those times where you're feasting, right? When you're feasting, that's a perfect time to not just spend and splurge. It's the perfect time to start setting money aside in your cash reserve for when you need it. That's kind of just real life in the trenches type of guidance there. But any questions as we wind it up and we review the 3 sessions from our 3 weeks and answer these 3 questions? Hopefully you got something out of it and something that you can take away. If you can't use it today, hopefully you'll be able to use it down the road.
Well,
Final questions, comments? Go ahead.
yeah, my compliments. Very good a webinar. But one question, right? Just regarding the past scenario, had the owner taken out 50,000 versus 100,000,
Gotcha.
then cash, would have increased, by 50,000, which would have provided a greater buffer,
I
right?
hear you. I
Right?
hear you. And it's hard to have those conversations with business owners that are making over $1 million and they're paying employees $100,000, but then themselves they only got to draw out 50,000. It's hard to have those conversations, but sometimes those are necessary conversations. So what Earl is alluding to is Maya took out $100,000 in owner's draw. He's saying, well, maybe she should have only took out 50,000, and that would have put her in a better cash position. I think was it Mark earlier that just talked about tightening the belt. So those are some of those harder cash flow conversations that if you have the numbers that you can start having those hard discussions and make those hard decisions early on. It's a great point. Thank you for bringing it up. Yeah, that would have helped to mitigate some of her cash flow. She may not have needed to draw down on that cash line of credit, and she may not have need to, taking out that loan. But then could her lifestyle sustain half of what she was drawing before? It's a full picture. You
Right.
have to look at the business perspective, but then you also have to look at her personal perspective. Could she have sustained with half of her revenue?
Yeah. Each
And I know,
case, each scenario is different. So, the example that you gave, it is one of the example of the businesses that this is can run in this way. But I'm sure reviewing the financials and quarter to quarter always, so to see where's what's something that you can fix before it's happening. So this is could be very important as well. What you said is seeing the expense and the income, how we can balance, how we can reduce the expense, how we can reduce income, increase income and reduce expense as well. And in this case, because she's providing service consultant, she's paying consultant, maybe she can just revisit her plan. Maybe if I reduce the number of consultant, maybe it might be there's certain, each business is different, but maybe this is another one. Instead of burning myself and bringing more client that I need to hire more consultant to pay them more, maybe I would reduce my services to stabilize my income and outcomes.
I
So
like that.
yeah.
I like that. Sometimes you have to contract in order to grow, right?
Mhm.
I like that. Wow, this is a great brainstorming session.
Yeah, it is.
I'm going to put it back in your hands when I know we're at past time. So thank you all for coming, and thank you, Emil and Common Capital, for hosting. Go ahead,
Thank you.
Emil.
Thank
I'll
you.
stop the recording.